Chapter 2, Part 2. Again, we're going to be talking about the language of managerial accounting. So we've already talked about types of businesses, the value chain, direct and indirect, product versus period, and total costs. But we'll go over those in case you didn't watch Part 1. Okay, direct costs, remember, those can be traced directly to the cost objective. Again, a dress, fabric, thread, buttons. Indirect costs that relate. They have something to do with producing the product, but you cannot trace them specifically. An example would be like a supervisor's salary. Now, we assign for manufacturing, must assign direct and indirect cost objective because we have to keep track of those costs. Now, for external reporting, and we must follow GAAP, we have two types of manufacturing costs. We have the product costs. These are incurred by the manufacturer to produce their product. They are treated as an asset called inventory until they're sold, and it includes direct labor, materials, and indirect costs associated with making the product. Period costs do not get treated as inventory immediately expensed. These are all the other costs that are incurred along the value chain, such as operating expenses. So the other thing is we must consider all costs across the value chain to see if we made profit. Now let's take a look at prime versus conversion costs and controllable versus uncontrollable. Now remember, we are talking about the same costs, we're just putting them in different categories. Now, a lot of times we'll talk about what are the prime costs. Prime costs are any costs that you can directly tie to the product. Direct materials, direct labor. Conversion costs are any costs that are added to WIP that allow you to turn it into a product, which would be manufacturing overhead and direct labor. Now, controllable cost, management is able to influence or change. An example would be how many employees they have or how much overtime they allow employees to work. Uncontrollable costs are costs companies are locked into in the short term, such as rent. Now let's look at relevant versus irrelevant. Relevant costs, differential costs. These costs change with the alternatives. These are the ones you're supposed to look at when you're trying to make a decision. Irrelevant costs do not differ among alternatives. And the most important one to ignore are what we call sunk costs. These are costs that have already occurred. You can't change them. So, example, you want to buy a new car for $20,000 and you can sell your car for $5,000, but it originally cost you $15,000. You currently pay $100 a month for parking. The relevant cost, the cost of the new car less amount for selling the old. The irrelevant cost is the parking because that goes on no matter what. And the sunk cost is the $15,000 because you can't change that. You've already spent the money. So it's irrelevant to the decision. So let's take a look at another example. You have two job offers. One's for 70, one's for 82. One, you can live with your parents for free for a year because it's right by where they live. The other one, it's going to be too far away, so you're going to have to find a place to stay, pay for your own food and utilities, and your car maintenance you're going to pay no matter what. What information is relevant? The salaries, the rent, the food, and the utilities. What information is irrelevant? The car repairs, because you have to pay them no matter what. What is the net difference between the choices? Well, you have the benefits and there's the costs. And so our net difference is $5,500. So it would be $5,500 more for you to move away and take the higher paying job. Now, based on this comparison, you probably should live with your parents. But you know what? The question is, do you want to live with your parents? And the other thing you want to look at is job potential. Which job has the most potential? I mean, those are the kind of things and you maybe have an opportunity to live with one of your friends and think of how much more freedom you're going to have. So those are all the things. You can't just look at the money. All right, the next thing we're going to look at is fixed versus variable. Now, this is really important to understand because we do a lot of cost analysis and we look at fixed versus variable costs. Fixed costs, they stay constant in total over a wide range of activities. So within what we call the relevant range, it doesn't change. And I think a good example is insurance because you paid at the beginning of the year. And if it's car insurance, it doesn't matter how much you drive, you've already paid it. And it's a fixed amount. It doesn't change. Variable costs change in total in direct proportion to changes in volume. They don't change on a per unit basis. The total cost is affected by the volume. And a good example would be gasoline. So direct materials are considered a variable cost because the more you make, the more material you use. Same with labor. The more you make, the more labor you use. Overhead is a mixture of fixed and variable costs. Product cost is a mixture of variable and fixed costs because it includes direct material, direct labor, and overhead. Now, the other thing we talk about is average versus marginal costs. We usually don't look at average costs because we know now, based on what we've just talked about, is there's variable and fixed costs. And these costs have a big impact on how you decide to do things. And let's take a look at an example because that's when we look at marginal cost. The cost of making one more unit is usually your variable costs. Fixed costs will not change if one more unit is made unless the plant is already operating at 100% capacity. Now that's something you always have to remember is fixed costs have to be within the relevant range. If you do something and now you're going to have to add a factory, then your fixed costs are going to change. So we have an example. We have variable costs of 100,000. We have fixed costs of 125. Our total costs are 225. Now remember, the variable are going to change based on changes in production, but the fixed costs are not going to change as long as we're within the relevant range, i.e., when we don't have to add to our fixed costs. You are currently producing 10,000 units and are not at capacity with an average cost of $22.50 and you sell for $30, so you're making a profit. What happens if somebody comes to you and says, hey, one time special order, you're never going to deal with them again? Now that's really important because you want to be very careful about doing this. Because if your primary competitors find out about it, they're going to want to only have to pay $20. And if you're working with a government contractor, you better just forget about it and keep your $30 because they don't like anybody getting a better price than they do. So, should you do it? If it's a one-time offer and you have excess capacity, the cost to produce one more unit is only $10, so you'd make $10 profit on each unit. So, now, let's go back to one more thing and let's go over these. And please, you might even want to print out this page. You need to remember the words. The types of business, service, merchandising, manufacturing. We focus on manufacturing. The value chain, the activities that add value to a company's product and services. Direct and indirect. Direct costs tied to the product. Trace it directly to the unit. Indirect, they have to do with making the product, but you can't identify them to a single unit. Overhead is an allocation made up of all indirect associated with manufacturing. Product versus period costs. Products are always treated as inventory or an asset until they're sold. Period are expensed when they incur. Total cost is all resources used throughout the value chain. Prime versus conversion. Prime are all your direct costs. Conversion is overhead and direct labor. Controllable versus uncontrollable. Controllable, you can change. Uncontrollable, in the short range, you can't change. Like a lease for 1 year. Relevant versus irrelevant versus sunk costs. When doing a comparison, you need only to look at the relevant costs, the costs that change based on you making a decision. Fixed cost is variable. Fixed costs do not change in total, but have an inverse relationship with changes in production on a per unit basis. That's why we do not look at fixed costs on a per unit basis. Variable costs do not change on a per unit basis, but change in total with changes in production. Average cost versus marginal. Average cost is units divided by total cost. Marginal cost is the cost to produce one more unit if not at 100% capacity. That ends this presentation.